Good evening. Welcome to STC's educational webinar. Tonight's webinar is entitled Self-Directed Retirement Accounts and Real Estate Investing. We're very happy to have you join us this evening, and we will have a Q&A session at the end of the webinar, so please do type your questions in to the question box, and I will get to those when I've completed the information. Before I begin, I do need to give you a bit of information about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also do not represent or sell securities or investments of any kind. We are not a registered investment advisor. And we don't represent or endorse any particular investment opportunities. And I will talk about a few different types of investments, but we don't represent or endorse those. Self-directed retirement account directed investing means that you do choose the investments, research them on your own, and choose them yourself. We do recommend that you consult with any legal, tax, and investment advisors you may have prior to making any investment. Now, this evening's webinar is going to give some basic information about self-directed retirement accounts in the event that that's a new topic to some of our listeners. I'm going to go through the benefits of self-directing, some of the guidelines that must be followed in all retirement account investing, a little bit about STC, and then we're going to talk specifically about real estate investing, choosing and funding an investment, and actually the process for purchasing real estate with an STC account. And then, as I mentioned, we will have Q&A. Now, I want to start with just a brief definition of what a self-directed retirement account is, what we mean by that when we use that terminology. And what we mean is that you're working with an organization like STC that permits you to choose any type of asset that is allowed by law, not simply what we may be willing to hold in your account, but anything that is permissible by law. And so that would definitely include real estate. Many companies, brokerage firms will not accept a real estate investment into a retirement account. But with a truly self-directed account, you can certainly hold real property in a retirement account. Self-directed also means that you, the retirement account owner, manage your retirement account investments. So if, for example, you purchase a piece of property and you decide you're going to rent it, you would be the one to make the decision on the rental rate, what tenants you wanted, if you were going to make improvements to the property, what those improvements would be, etc. You would make the decision. So you truly do have control over what's happening in your retirement account. Now, the self-directed industry has grown significantly over the last 10, 15 years. People haven't been totally satisfied with the returns they were getting in their brokerage retirement accounts necessarily, and many people did want to expand into real estate. So we do see a large number of investments in self-directed accounts that are real estate types of investments. Now, I want to go through with you just for a minute or two types of retirement plans, because some folks have the mistaken idea that a self-directed plan is a type of plan, and that's not true. It just simply means that you're holding it with a company that permits self-direction. So a traditional IRA can be a self-directed plan. Traditional IRA, individual retirement account arrangement, and a Roth IRA, these are pretty common. Many people know about these types of accounts. One big difference between these two is that with a traditional IRA, like the majority of qualified retirement plans, your contributions into your retirement plan are pre-tax. You don't pay taxes on that contribution. You pay taxes when you begin taking qualified distributions upon reaching retirement age. That's when you pay taxes. A Roth account is different. Roth contributions are post-tax. You do pay tax on the monies you contribute into a Roth account. However, when you begin taking qualified distributions, those distributions are not taxed. So what that means is all of the growth in a Roth account is not simply tax deferred, it's actually tax-free growth when you're taking a qualified distribution. So a Roth account does have some advantages. Just a quick note, the maximum allowable contribution into each of these accounts is for 2016 is $5,500. If you are 50 years or older, you can add another $1,000 to that. So $6,500 of earned income can be contributed into these accounts. Two more plans I'm bringing up on your screen: a STEP, Simplified Employee Pension Plan, and a Simple Plan, Savings Incentive Match Plan. These are plans that are oftentimes used by sole proprietors or small business owners with a few employees. These allow for larger contributions. They allow for both an employer and an employee contribution. So if you have your own business, you may want to look into one of these types of plans and see if that would serve your purposes. And they can, of course, be self-directed. Now I've brought out on your screen 4 plans that all say former employer. 401k plans are corporate, for-profit company type plans. 403bs, charitable organization, nonprofits may have 403bs. TSAs, tax-sheltered annuities, TSP, thrift savings plans. If you formerly worked for an employer and participated in one of these types of plans, you can take the monies from that plan once you're no longer employed and roll that money over into a self-directed plan such as a traditional IRA. So I have talked to many folks who have worked at a number of different places and they've had little pots of money in different 401k plans. They can take all of those pots of money and roll them over into a single traditional IRA, or if they qualify for a SEP, and get all that money in one spot if they wish. So something to think about if you might have multiple accounts. Now I will also mention that if you don't have one of these types of plans, but you would like to, you qualify for one, you do want to get that set up by December 31st in order to make a contribution for this year. So you need to have the account open. So go ahead and move on that if you're in that situation and you'd like to do that. Now let me talk a little bit about the benefits of self-direction. Maybe one of the most significant is that you can truly diversify your retirement portfolio. You can include what some consider non-traditional assets like real estate, mortgages and notes, private businesses. So you're not limited to strictly brokerage assets like stocks and bonds and mutual funds. So true diversification, most financial planners think that diversification is very healthy and good for your investment portfolio. As I mentioned earlier, you choose and control the investments in the transactions. You can also increase the buying power of the monies in your retirement account by using leverage. And I'm going to talk a little bit more about that in a couple of slides. And because of all of these things, you may be able to experience a significantly higher return on your investments than you would with strictly a brokerage type account. So let's talk a little bit about using leverage in your retirement account. This would be getting a loan on a real estate property, and you can do that. The entity that is getting the loan is your retirement account, not you personally. So your retirement account will be getting the loan, and it must be a non-recourse loan. And I'm going to describe that a little more on the next slide, but I want to give you an example. This is one of our clients did this transaction. She purchased the property, and her intention was to rehab it and then sell it. The purchase price of the property was $250,000. She took $125,000 cash from her retirement account, and she financed with a non-recourse loan the other $125,000. Then she took another $50,000 from her retirement account, and she paid that to a contractor to renovate the property. 9 months later, she had sold that renovated property for and netted $100,000. She actually sold it for $350,000. So she netted $100,000 on that property, which gave her a 7% return over that 9-month period and 76% annualized return. So if you happen to be a real estate investor, using the monies in your retirement account to your real estate investing experience advantage may be very, very good for you. And certainly there's a possibility, and we have many clients do that. So now let's talk a little bit more about that non-recourse loan that client used in her transaction. What is a non-recourse loan? What it means is that the security instruments, the notes, the mortgages on that loan, allow no recourse against the individual account holder or the balance in your retirement account. In the event of a default or a foreclosure, the property is the only source of repayment. So in other words, there's no other recourse except the property that the loan is on. That's where the term comes from. Now, a non-recourse loan is more like a commercial loan. There's no income or employment verification, and obviously your retirement account doesn't have a job, so it's not a person. So there's no income or employment verification. Now I'm going to tell you, these are just general industry standards. What you would need to do and want to do is do some due diligence research and talk with several non-recourse lenders, see what kind of terms they would offer you on the particular type of property that you are looking at. These are just some general industry standards. A specific lender might differ from these somewhat. So generally, the required documentation is going to be the loan application. They're going to want to see the purchase and sale contract. They're going to want to see a copy of your IRA statement. They will want an appraisal of the property, and if it's a rental property, they're going to want to see the rent roll. General required documentation for this type of a transaction. Loan guidelines. The maximum loan to value is generally 70%. So you would have to put 30% down on the property. Maximum term, 20 to 30 years, depending on who you're working with. And some companies do offer ARMs, 3-1, 5-1, 7-1 ARMs for non-recourse loans. They are also going to look for an income to expense ratio for the property. And they're probably going to want that to be about 1.25. So 1.25 income to expenses. And most companies will also require that you hold a reserve in your retirement account, and that could be anywhere from 3 to 6 months of normal expenses of the property. Now, some properties are eligible and some are not. So eligible properties include things like single-family residences, some condos. Again, this would relate to the particular lender. 2 to 4 plexes, so duplexes up to 4 units in one building. Multifamily units, that could be 5 or more. And retail, office, and warehouse properties. Those are eligible. Ineligible properties generally include mobile homes, timeshares and condo hotels, certain restaurants, and again you need to check with the lender, residences that have 5 or more acres, and farms. Those are usually ineligible properties for non-recourse loans. So just a little bit of information about non-recourse loans if you might be interested in looking into them. And again, you would just want to do some internet research, locate several different providers of non-recourse loans, and then talk with them directly about what they offer for the type of transaction you're looking at. Now I want to give you just a few of the guidelines related to self-directing your retirement account. And these have to be fulfilled for all retirement accounts. There are administrative requirements. An annual valuation of your account must be done and an annual report submitted to the IRS, Form 5498. Books and records of all of the details of your transactions, your purchases, your expenditures, money's in, money's out, all that must be maintained and reported. State filings may be required depending on what you own and where you own it. And in some rare instances, tax returns can come into play. Those come into play if UBIT, unrelated business income tax, or UDFI, unrelated debt finance income, are triggered by a transaction in your retirement account. Pretty rare. But with a real estate transaction, if you use leverage, that can come into play. So something you want to consider in the decision-making process of the transaction. STC is a full-service administrator, so we do fulfill all of these administrative requirements, with one exception. We are not permitted to do a tax return for your retirement account. If that should come into play, what we do is provide you or your tax preparer all of the necessary information so they can file that tax return if that comes into play in their account. Now, some additional guidelines. There are some assets that are prohibited that may not be owned in a retirement account. Number one, life insurance contracts. Number two, collectibles. Things like rugs, works of art, stamps, coin collections, anything that is collectible may not be owned in a retirement account. Additionally, there are some transactions that are prohibited in retirement accounts. Transactions that are not for the exclusive benefit of the account, so you do need to be engaged in investing to grow your retirement account. That's why it's given tax preferential treatment by the IRS. So you do need to be investing for the benefit of your retirement account. You cannot personally borrow from your retirement account. That is a prohibited transaction. You also cannot pledge retirement account assets to secure a personal loan. And you cannot utilize your personal credit or guarantee to obtain a loan for your retirement account. That's why it must be a non-recourse loan. And you also cannot benefit any disqualified person. So now you may ask, well, who's a disqualified person? And you'll see the first person that I put on the screen is you. You and your retirement account are two distinct entities, and you are not permitted to do a direct transaction with your retirement account. So let me give you an example of that. Let's say that you personally own a rental property. Your retirement account cannot purchase it from you. That would be a direct transaction between the two of you, and it would violate the disqualified person rules. There are other family members who are also disqualified. If you are married, your spouse is also a disqualified person to your retirement account. Ascendants and descendants are disqualified, so that parents, grandparents, great-grandparents on up the line, children, grandchildren, great-grandchildren on down the line are all disqualified persons to your retirement account. However, lateral family members are not disqualified. So that means brothers and sisters, aunts and uncles, nieces and nephews, first, second, 12th cousins. All of those parties are not disqualified, and your retirement account can do a direct transaction with them. So just a little nuance to keep in mind, and just keep in mind when you're thinking about who you're doing business with in your retirement account. There are also two entities that are disqualified persons. Any company, if you're a majority shareholder, and that doesn't mean more than 50%. If there are three parties to the ownership of a company, if you have majority ownership, if you own more than 33 1/3%. So a majority shareholder. Any company, if you are an officer, a director, or a highly compensated employee, is also a disqualified party to your retirement account. So something else to keep in mind when you're thinking about who you're going to do transactions with. Now I'm just going to quickly go through our approach in providing service for our clients. We do set up a retirement account LLC structure. I'm going to explain why we do that and the benefits to you as a client in that structure on the next slide. We do have CPAs and attorneys available to answer your technical questions. We offer unlimited guidance on transaction compliance. We'll talk with you about how your transaction needs to be titled. We'll review all the parties with you. So we'll make sure that your transaction complies with the IRS rules. We'll handle all that back office support, maintain LLC financial statements, will supervise the regulatory reporting that's required, and will oversee the annual valuation that must be done each year. So we really do all of those kind of back office things that need to be done for retirement accounts so that you can focus your time and your efforts and energy on finding the best investments for your retirement account. And we'll help you with all of the administrative functions. Now, I mentioned that we set up an LLC structure for each of our clients' accounts. And we do that because it has a number of benefits. It offers maximum flexibility in structuring transactions. And many clients come to us who are doing very complex transactions. There may be multiple parties involved. There may also be leverage involved. There might be a non-recourse loan involved. It could be a rental property. It could be rehab going on. So using the LLC structure really gives you maximum flexibility in partnering and getting a loan, etc. It does also provide an additional layer of asset protection. It is a limited liability company. It also gives you checkbook control over your retirement account funds. So that means that you have immediate response to investment opportunities. Now you'll notice I have checkbook control in quotes, and that is because FTC does not give the checkbook to the client. Some companies do that, we do not, and we don't really as a protection for you. If you were to unknowingly engage in a prohibited transaction, there can be penalties associated with that, up to forfeiting your entire retirement account. So rather than put you in that precarious position, what we do is we review your transaction, and then if we have all the paperwork and supporting documents by 2 p.m. Eastern Time, we can same day fund that transaction, next business day if it's after that. So you have, the protection of experts looking over your transaction, making sure that it is in compliance with the rules, and still have the ability to quickly fund the transaction so you don't lose out on a good deal. This structure also simplifies asset titling. I'll tell you this again when I go through the real estate investing process, but with this structure, if you're purchasing real estate, you can actually go to the closing on behalf of your retirement account and sign the closing documents on behalf of your retirement account. You don't have to send the documents to our office and we sign off on them. You can do that. You can go to closing. So it simplifies asset titling and transfer of title. And it also eases pooling or partnering with other funding sources. So that's a really important feature for many folks. So we use this structure for each client's account. This LLC is a very specific type of LLC. Its operating agreement and its organization documents are designed to be owned by a retirement account. So it's a very specific type LLC, and we set one up for each of our clients' accounts. So this is just a little schematic of how the setup would work. You'll see on the upper left, current custodian. If you have a current account and you decide you want to open an account with us, you would fill out some paperwork that would direct your custodian to transfer or roll over the funds to our self-directed custodian. While that is happening, we would be setting up the LLC in the state of your choice. Once the monies have been received at the custodian and your LLC setup is complete, then your retirement plan funds move to a bank account that your LLC has access to, and the ownership interest of the LLC moves to the custodian. That's what they hold in their account. And now you're ready to start investing. And here, this retirement account has 3 investments. I haven't enumerated what they are. It could be a variety of things. So that's just a general schematic of how the setup works. Now let's talk a little bit about the variety of investments available to you, and then we're going to go into real estate investing. You have so many options with a self-directed account. I've brought out onto your screen now different types of real estate investments. Single multifamily homes, vacation property. We have some folks who own vacation property in Costa Rica, let me mention here, though, this is vacation investment property. And if your retirement account owns it, you cannot personally use it, nor can your spouse or your parents or your children. Remember that disqualified person rule. So it truly does need to be investment property. Now, you could send your brother and your sister-in-law there because they're not disqualified persons. But keep that in mind with vacation property. Raw land, building lots, commercial buildings, real estate syndication, so maybe a group of investors are getting together to do a real estate transaction, and tax liens. If you have a smaller balance in your retirement account, tax liens might be an option that you'd be interested in. You can also purchase mortgages. You can also make loans from your retirement account. You can invest in private businesses. You can invest in operating businesses. Here I will mention that you do need to be careful that you don't personally work for that business or any disqualified person. So your IRA can't purchase part of an operating business and your son work there. That would be a prohibited transaction. So again, you'd want to talk with us about these types of investments and who the parties are so that we can make sure that you're following the guidelines. Don't get yourself in trouble. And also precious metals. You can invest in precious metals and the Forex market, foreign currency, options, futures, and of course you can always have part of your self-directed retirement account in stocks, bonds, and mutual funds if you like. So now let me just go through the simple process of investing if you're a FTC client. The first step, and I highly recommend this even though it's optional, is to request a review of your transaction and the structure of your transaction in advance of actually making the investment. You can call our client services department and they are happy to talk with you, walk through any questions you have about the transaction, look at your documents to make sure that they are in order. So I highly recommend that you take advantage of that. There's no additional charge for that. So they want to make sure that your transaction is viable and they'll be, it can be funded right away. Then we have a form. It's called a request transfer of funds, and you would complete that form. It tells who the seller is, where they're supposed to send the money, how you want that sent, and then any supporting documents. So if it was a real estate transaction, I'll go through some of the things that would need to be included. So you would fax, I guess you could mail, but most people fax those documents to us. And then our client services department reviews those documents. If there are any questions, they would call you, email you right away, and walk through that with you, talk through it, make sure that they understand, or if there's any problems, they would talk with you about those. And then they would that form. And the funds would be sent from that LLC bank account to the seller. So you don't become an intermediary at all. The money goes directly, which is how it needs to be. The money goes directly from your retirement account to that seller. And again, we can do that 24-hour turnaround time. Have the documents by 2. We can often do it same day or next business day. So now let's talk more specifically about real estate, purchasing real estate. Now, we cannot help you find a property and tell you it's a good deal or suggest that you invest in it. This is self-direction, so you're going to be doing the due diligence and looking for the property, looking for the investments yourself, and when you locate that property, you will make an offer on it. Now, the offer must be in the name of the buyer. In this case, it's your IRA LLC name. So when you set up an account with us, you tell us what you want the name of that LLC to be. And just say it's ABC Investing LLC. And so any transactions that you engage in are done in that name, ABC Investing LLC, never your personal name. Now, oftentimes an escrow deposit is required, and if you need that, then we will need a copy of the contract showing that IRA LLC as the buyer, and also a completed request to transfer funds form, that form that I mentioned on the That's what we'll need, and we can get you an escrow deposit from your retirement account. We do ask for at least one business day before closing. More would be better. So if you're going to closing, we'll need a copy of the estimated HUD or settlement statement showing again the IRA LLC as the buyer and a completed request to transfer funds form. So we'll need those documents by the day before closing. And we can, and that is really the latest. It really would be better if we had it sooner than that. It is best to provide additional time in case there is an issue. For example, if the buyer's name is not listed properly on that form, on that HUD form, we will not wire the funds. We won't send the funds. We're not committed to. That would violate that prohibited transaction rule. Or another example, if the funds from for a down payment did not come from your IRA account, if they came from you personally, that's a problem. So if you have personally put a down payment on a property that you want your retirement account to purchase, you will need to get that retitled. You'll need to get that fixed before your retirement account can purchase that property. So please do, I just highly recommend it. Talk with our client services department before any money moves, and they'll help you make sure that it's all going to work easily for you. It can be a very easy process. Now, typically the disbursement of money for a real estate property purchase needs to be guaranteed funds. So our clients usually request that we issue a wire transfer. We can do that. The other option is a bank official check. We can also do that. Just want to make sure you have enough time for that check to arrive for closing. So we can do that. Then you, the client, go to the closing and you sign all the documents. Again, we'll discuss the transaction with you in advance, but we don't need to approve or sign the documents as is required with many custodians. We do ask that you send a copy of the closing documents to STC, and then you can keep the originals. Now, you do have the option to use borrowed funds to purchase. Remember, I talked about non-recourse loans. It does have to be a non-recourse loan. And UBIT, unrelated business income tax, can come into play. It's actually a subset of UBIT, unrelated debt finance income. That's what this property may be earning for your retirement account, unrelated debt finance income. I cover that topic in detail have covered that in a previously recorded webinar. If any of you have questions about UBIT, UDFI, you can email me and I can direct you to that webinar or answer any specific questions. Now, I'm going to tell you that you can partner with other funding sources to purchase a property. And if you're using borrowed funds, and if you are partnering with personal funds, which is permissible only at the inception of the transaction, and you need a loan for the personal funds as well. So let me just describe this a little bit. Let's just make it even numbers. Let's say the property costs $100,000. Your retirement account has $30,000. You personally have $30,000, and each of you is going to fund the remaining $20,000 of your 50% with a non-recourse loan. If you are personally funding your personal part of the ownership, that also must be a non-recourse loan. You cannot personally guarantee if your retirement account is involved in the transaction. So just keep in mind, if a retirement account is involved, if any loan is involved, it must be a non-recourse loan. And again, client services can go through all those details with you. Now, I just mentioned partnering with yourself, but I had also told you that you were a disqualified person to your retirement account. Well, you can actually partner personal money and your retirement account and other disqualified persons with your retirement account as long as that partnership happens at the inception of the transaction, the inception of the purchase transaction. So what that means is each of the parties is transacting directly with the seller. There's no transacting with each other. And so it doesn't violate that disqualified person rule. So you can partner with anyone at the inception of the purchase transaction. If you partner with disqualified persons, so back to that example, personal money, your retirement account money. Let's say you were partnering 50-50, 50% owned by you, 50% owned by your retirement account. That ownership percentage can never change. For example, let's say you buy a rental property and you need to replace the heating, air conditioning in that property. If you each own 50%, you personally and your retirement account personally, then that cost of that new heating AC system has to be borne 50% by you personally, 50% by your retirement account. Otherwise, the ownership percentage would change. Who had more invested? You have to keep that ownership percentage always. All property expenses are paid based on that ownership percentage. All the revenues coming into this property are distributed based on that ownership percentage. So again, if disqualified persons are involved, you cannot change that ownership percentage. Now, what a lot of folks do is they set up a sub-LLC to own the property. And I say sub because this LLC is going to be owned by your IRA LLC. All the same rules apply. All the rules relating to the retirement account still must be followed. So in this scenario, let's say you decide to do this, what FTC would want to see is an operating agreement for the sub-LLC stating clearly who the owners are, the amount that they are contributing into this LLC that's going to own the property, and their percentage of ownership. And we would expect the percentage of ownership to match up with the amount invested. And that's actually a requirement if any of the owners are disqualified persons. Now, if the owners are not disqualified, and if one of the parties is serving another role, for example, let's say you're buying a property and you're going to rehab it, and one of the parties to this purchase, nobody is disqualified, so everybody is permitted in this transaction. One of the parties, though, is going to serve as the general contractor for the rehab. Then they can have a larger percentage of the profits based on that additional role they're playing. So they might invest the same amount of money but have a larger percentage ownership because they're also doing work on the project. That can work. Again, only if none of the parties in this transaction are disqualified persons to the retirement account. So kind of have to think through all these things. And again, call our client services department. They will talk and walk through this with you as much as necessary. Disqualified persons cannot do rehab or repairs. So again, let's say you and your retirement account buy this property together. You are a disqualified person. You can't do rehab or repairs on this property. Disqualified persons, remember that father, ascendants and descendants, cannot be the tenant, the buyer, or the seller. So you can't buy a property with your retirement account and then let your college-age child live in it while they go to college. Cannot do that. That violates the rules. Let's see if I had any more notes here. Oh, I did have one more note about this sub-LLC. I said all the same rules apply, and I just want to remind you that if the sub-LLC also does a non-recourse loan, then UBIT still applies. having the sub-LLC does not negate any of the rules related to the retirement account. It is still owned ultimately by a retirement account, and that's how the IRS is going to view it. I do have some folks who are real estate agents interested in real estate purchasing in their retirement account. And we highly recommend, if the client is a licensed real estate agent, we really encourage you not to get involved with any transaction in your IRA as a real estate agent. The IRS scrutinizes those kinds of transactions, so we really discourage you from being involved in that. If a client were to insist, you cannot receive any compensation because that would be a personal benefit from a retirement account transaction, and you're a disqualified party to your account. The only way that could work is if there was a reduced cost to the IRA. Please, we ask you, if you're going to do that kind of transaction, call client services and talk with them about it before you do anything. We want to make sure you understand the difficulties that could be encountered with that type of transaction. So real estate agents, you can help other folks with their retirement accounts, but we really discourage it with your own personal account. Now, partnering with others. I mentioned that you could partner with other people and that our LLC made that a simple process. And here you're going to see that the first three people I bring out that you can partner with are yourself, your spouse, and family members. Now, I told you earlier that they were disqualified persons, but they aren't, again, if you invest at the inception of the transaction. If you are all party to the transaction at the inception of the purchase transaction, then it is permissible. You can also partner with investing colleagues, friends, other LLCs. Again, keep in mind those rules. Investment syndications. So many ways that you can partner with other funding sources to co-own an investment. And in fact, here's an example. Again, we've got that same schematic I showed you earlier. And here we see investment number 1 is tax lien. Investment number 2, purchase property for rehab and rental. And investment number 3, pool funds with others to purchase a small retail center. And you'll see the others are your father, your daughter, and some of your personal money. Normally, those 3 parties would be disqualified persons, except if they co-invest at the inception of the purchase transaction. So this type of transaction can certainly be done, and we can help make sure that it's structured properly so that it does not violate any of the IRS rules. Now, this is just a quick little example here. We had some folks do something similar to this. I rounded all the numbers to make it easy to explain. But a group of people got together to purchase an apartment building, and the purchase price was $2 million, and they paid 100% cash. That came in the form of $200,000 from 10 people. And each person was contributing $100,000 of retirement money and $100,000 of their own money. Again, this isn't, I just made these all numbers the same. It could be any combination. But basically what we have are 20 members of a new LLC. They formed a new LLC with 20 members. There were 10 people who were members and 10 retirement accounts who were members. Each member, in this case, owned 5%. They all contributed an equal amount, $100,000. The rents from the apartment building were paid into this LLC. Expenses were paid by the LLC, and then the net income was distributed down to the 20 owners. 10 people, 10 retirement accounts. So that kind of a transaction can work. Again, if you have disqualified persons, they can do it at the inception of the transaction, but the ownership percentages can never change. Okay, well that is the information I wanted to share with you, and now I'm going to open the floor for questions and answers. So please take a moment to, if you haven't already, type some questions into the question box. That's the little you look on your task pane, you will see a line that says questions. You click the plus sign next to the word, and it will give you a drop-down box where you can type in that. And give me a moment to read some of these, and then I will start answering questions. Okay. Okay, rehabbing a property. This is a multi-part question. Can the account owner be the general contractor for the rehab of the property? The answer is yes, they can be, but they have to be very, very careful. You can serve as a general contractor as far as deciding which contractors to hire, checking to make sure the work is being completed in a timely fashion. However, you shouldn't be spending all day at the job site like it's a job, or you shouldn't be running out to buy supplies. So you can make those overarching decisions, but you can't really be doing any of the work. So you do need to be careful about that. And of course, you would be making the decisions about what rehab you want done and what kind of tile you want in the bathroom. You would be making those decisions because your retirement account owns the property, but the subcontractors would be the ones to go pick it up, and we would get invoices for what you were purchasing to STC, and we would write checks out of your retirement account to pay for those things. Okay, looks like I'm starting to get some questions about tax liens. So let me, okay, tax liens. Tax liens are pretty interesting things. Every jurisdiction has their own way of selling tax liens. So what we ask our clients to do is you need to have information to us about the jurisdiction, what the jurisdiction requires. So I'm going to give you some general information, and then I'm going to look at these specific questions. Some places, some jurisdictions require proof of funds. And what we will do, and so up front, let me just say, what you want to do is you want to call our client services department. Tell them the specifics of the transaction in the jurisdiction, what you need in order to purchase a tax lien, and then they will work out the plan for you to be able to do it, because it's just a wide variety of ways that they can work. Some need a proof of funds. So client services can prepare a letter that's emailed to you, the account owner, as an attachment so that you can print it or forward it as you need to. And we ask you to tell us how much you want listed in that proof of funds letter up to the maximum in your account. I mean, you may not want whomever you're purchasing from to know that you have $500,000 in your account. You may only be interested in listing $50,000. So we will put in that proof of funds letter whatever you tell us up to the maximum, up to the full amount in your account that's available. Deposit. Some places require deposits, and we will issue a deposit check. What the client does is sends us a request form and a copy of the advertisement for the tax sale, and then we can issue a deposit check. Now, some jurisdictions, I've heard, require ACH, as automated clearinghouse payments, and meaning the payment must be deducted from an account. And so then what we do is we set up an account, a special account. It's basically a zero balance account. And as you tell us how much money you're going to pay, we put that much money into the account. You set up access to that account, then you can move that money over to the seller of that tax lien. So money is moved into and out of that account as needed for a specific purchase. So we really encourage clients to review the requirements for the tax sales and then call and discuss them with client services. Some jurisdictions require the funds same day. We know that. Some only accept checks from a bank that's in their state. Some won't refund any overpayment, even after the check clears. So it really is important that you, the client, have done your homework first. You make sure you know all the ins and outs. You communicate them to us, and then we will make it work. We have many clients that do this successfully. Some do buy properties at tax sales where we need to overnight guaranteed funds to the seller the same day because it must be paid in full in 24 hours. We can do that. We also have clients that bid at auctions where funds must be deducted from a checking account. And so that's when we receive that request form and the ad, and we transfer funds into that special account, and we give you the information to access that account. And then once that's set up, let's just talk about that account because I think that happens fairly often. Once that account is set up, we do ask for proof that you registered in the name of your IRA LLC, because it does have to be in the name of the IRA LLC because that's where this money is coming from. Cannot be in your personal name. And then after you bid, we need to see the documentation of the liens that you actually bought and the amount that you paid for each one, and that needs to be the exact amount that was withdrawn from that special account. So we can make it work for you, and we will do that if tax liens are what you want to purchase. But again, you do want to make sure, of ultimate importance is that when you're registering for the tax sale, you need to register in the name of your IRA LLC. And that LLC has an EIN, an employer identification number. That's the EIN you use. You do not use your personal name and your personal Social Security number or your personal business name. So that's really of first importance, how you register with the entity. I think I have answered those questions with what I just said, that I find the tax lien questions. If you have another question, please do type that in, and I'll move on to the next one in the meantime. Okay. What is the time frame to get my account up and running with FTC? Okay, typically we ask for 4 to 6 weeks. It doesn't always take that long, but we do, from the time we get the original paperwork to the time your account setup is completed, we do ask for that time frame. So if you know that you are already starting to look for properties, please do fill out the paperwork immediately. And just because you found a property, if your account setup isn't complete, we can't fund the transaction yet. What takes the time is we do have to set up the LLC with the state. We have to get that incorporation done. The money do need to move from your custodian to our custodian. Depending on who you are invested with, that can sometimes take a bit of time. Some custodians are slower than others in moving the funds. And then once the funds have been received at our custodian, then the paperwork needs to be executed that moves the monies into your bank account, the bank account that your LLC has access to. So to complete that process, we do ask that you give us a few weeks. Now, once the process is complete, once your account is set up, then you have that same day or next business day funding available to you. Then you have immediate access to those funds. It's just a setup that does take a bit of time. Okay, another question. Oh, I'm running out of time. Can you open an IRA account if you are over 60? And what is the minimum initial deposit? You can open an account if you're over 60. Not if you have reached the age of 70 and a half by the end of that year. That's the cutoff. So you can, and if you receive taxable compensation during the year, you can make a contribution to that account. And the amount to open an account, that really depends on the custodian that you're using. For us, it ranges from $250 to $500, depending on which custodian we work with. And if you were transferring money, then whatever you're transferring, as long as $250 or more would be sufficient. So a transfer works to open an account with us as well. Okay, okay, I've got two more that relate to real estate, so I'll take those. I want to start investing in real estate, but I don't have enough money in my IRA to buy a property outright. Do I have other options? Well, of course, yes, you can partner with other individuals or with your own personal funds if you have personal funds. As I talked about, so that would be an option, finding co-investors. You can also, of course, consider borrowing funds using that non-recourse loan. And there is another option. It's not the same as purchasing property, but you could also loan funds from your retirement account to somebody who is purchasing a property, and then have a lien on that property, so that if there was a default on the loan, you could foreclose on that property. So you can, you can do that kind of thing. You can loan money. And again, I would say tax liens. Many people do tax liens. Tax liens in some states generate a very high percentage of interest, and if there's a default on the payment, they are foreclosable liens, so you can actually foreclose and then own that property in your retirement account. So something you may want to consider. If you have a rental property in your account, who does the renter send their rent check to? And the answer would be that really depends on if you're using a property manager or not. We highly recommend using a property manager. Property managers, can be the buffer between you and your retirement account and you and your renter. So typically, the property manager would collect the rent. The checks are made payable to them, and then they forward your IRA LLC, the excess funds. So they would write a check to your IRA LLC and send it to FTC. If you're not using a property manager, then the checks need to be made payable to your IRA LLC and mailed to our office. They can be mailed to you, but then you need to mail it directly to us. So just as easy to have them mailed directly to FTC, and we will deposit that into your retirement account. Well, folks, I am sorry I am pretty much out of time. If questions come to your mind after the fact, please do get in touch with me. I would be happy to talk with you. My email address is jknight@ftcira.com, and our website is ftcira.com, so you can get more information there as well. Thank you so much for joining me this evening. We do have monthly educational webinars, so I hope you will look for an invitation or check out our website to join us for next month's webinar. Thank you so much, everyone. Have a great evening. Good night.